Virtually everyone in the world of finance today, and even a ton of people that are outside of the sector, are keeping their eyes on the yield curve. The reason for this is that it's one of the most accurate predictors of a recession, but there's a lot more to unpack than simply watching the spread between the 10-year and the 2-year, and when the yields invert, we sell everything. So we're actually going to go into a lot more detail than most discussions on the topic, because I feel like there's a surface level understanding that can be taken much deeper. And if we're going to be making financial decisions, especially whether or not to buy or sell or hold, we have to have a thorough grasp on this concept, much more so than a typical article in Business Insider is going to give us. So in this episode, we're going to discuss what we mean by the inversion of the yield curve and why this metric communicates that there's fear in the marketplace. What does an inversion between the 5-year and the 3-year mean for the 10-year and the 2-year? And if we do have a recession, does it necessarily mean that prices will go down? We'll look at some of the historical data on this because it may paint a picture which is slightly different than what you might anticipate. And of course, the old question that economists hate to ask but need to know the answer to, which is, will it be different this time? Hey, don't forget to subscribe in iTunes if you haven't already. This is the easiest way to get episodes automatically downloaded to your phone when they're released. That way you don't have to go back and search for them. We have some absolutely awesome episodes coming up. In fact, we just scheduled an interview with Bruce Norris, who is an extremely successful real estate investor, a very influential market timer in the real estate sector. This is something that you absolutely do not want to miss. And the way to ensure that you don't miss it is to just smash that subscribe button in the podcast app. Of course, while you're there, if you haven't yet left a review, make sure to do so. As you know, it helps the show tremendously. All right, hope you enjoyed the episode. How's it going, everyone? Our guest for today is Ali Wolf, who is the Director of Economic Research for Meyers Research. As head of the economics department, Ali manages and analyzes the content for the firm, provides data analytics, runs special research projects, and does presentations across the country on topics spanning from both the housing market as well as the wider economy. Prior to joining the Meyers team, Ali headed macro, regional, and metro-level monthly economic reports at John Burns Real Estate Consulting. She was also a researcher for both the Canadian and the UK parliaments. She holds a bachelor's degree from the Ohio State University of Economics and a master's degree from the London School of Economics in Real Estate and Finance. And today, we are going to talk about something that is talked about all the time, more and more so, which is the yield curve and a potential of a inverted yield curve and what that talks about. This is something that we were talking offline. It's one of those things that is frequently repeated, but I think that the level of true understanding is not deep enough. So that's exactly what we're trying to accomplish today. But before we go into the specific details, Ali, first of all, welcome to the program. Thanks again for coming on. We'll link to your previous episode in the show notes page. Before we jump into those details, let's start with the basics. What does the yield curve refer to, and what does the implications of the yield curve really mean?
All right. So, hey, Hunter, I'm so excited to be back. This topic, as you said, has just become very timely. So everyone talked about the yield curve, but it became a pretty big issue in December. So we can get to why it shifted then, but basics, just if you think about the yield curve, basically charts out yields against bond maturities. So if you're going to invest in a 3-month or a 1-year or a 10-year bond or bill, it tells you what your return will be on that investment.
Okay, got it. And so generally speaking, I guess talk about the relationship between, typical and normal economic situations, the relationship between the shortness of a bond and the longness of a bond and the yield between those two comparatively.
Sure. Okay. So short term, generally the interest rate is set by the Fed. Long term, usually set by investors. But what you need to realize is if you're going to place your money somewhere and you're going to tie it up for a short period of time or a long period of time, that's obviously going to influence the return that you're looking for. So if you're going to put it in a short period of time, let's say 2-year, you would expect that your return would be lower because you're going to get your money back. You're going to be able to reinvest it, versus if you hold it up in a longer period of time. So yield curve, as I said, you chart out the yields against the maturities. It's generally upward sloping.
Okay, got it. And so we're on the same page there. The relationship between prices of a bond and the yield of a bond would be basically the opposite of one another in the sense that the more you're willing to pay, the lower the yield will be. Is that kind of a fair assessment of what you just outlined as well?
Yep. So as there's more demand, then the bond price goes up and the yield goes down. So yes, it's an inverse relationship between the two.
Okay. So let's talk about, and I know that this is kind of a broad sweeping statement. It's like when people say, hey, the real estate market is up, and you're like, which market? So I don't want to make that mistake, but just sometimes we have to make generalities. One of those generalities is basically saying, quote, normal economic times. So, in quote, normal economic times, when the market is not generally concerned about recessions, for example, what would you anticipate to see when you compare a 2-year bond with a 10-year bond in terms of the discrepancy there in the yield?
Yep. So you would expect the spread would be pretty far from zero, meaning your longer term is going to give you a far higher return than your shorter term, the 10 and 2. So that's exactly follows logic. Tying your money up longer, you get a higher return. Tying it up shorter return, completely makes sense. That's if everything's going well in the economy and there's not a concern in the world.
Okay, got it. So I looked at some data just kind of in preparation for this conversation. It seems like maybe a 1% difference or 100 basis point difference would be kind of a reasonable expectation in terms of normal economic times. Would that be a fair assessment of the data? I didn't go into the details, but just looking at the graph, it seemed like that was at least reasonable.
Yes. Yep. That makes sense.
Okay. So, yeah, go ahead.
Are we going to talk about where it is today? Because if 100 basis points is normal, 15 is where it is today.
That's a very good point. Okay, so 15 basis points with 100 being normal, 100 being basically a 1% difference in that sense. Mm-hmm. And that would be what we consider when most of the market is not concerned about that. Now we've got 15% of that. So it's pretty close. Now, what does it mean typically if the yield curve inverts? Now, what does it mean technically? Like, what does that actually mean? And then what does it mean like implicitly, I guess?
So technically what it means is now all of a sudden your 2-year is going to give you a better return than your 10-year. And when you actually think about it, this to me is representing a change in perceived risk. And so right now, and I think we'll hit on this in a minute, but when you talk about where the bond market is today, a lot of people are saying, hooray, we'll hit on it about how it relates to mortgage rates. But right now, the reason that the 10-year is down is because people are nervous. Investors are nervous. China is slowing. We have tariffs. The U.S. economy looks a little shaky. U.S. housing market looks, it had a big slowdown fourth quarter of last year. So the curve right now is representing uncertainty in the market. And so there's more interest in a safe government bond. That's going to push the price up. That's going to push the yield down. And we're talking the longer term, which then inverts the yield curve.
Okay, that's actually a really good point. So what you're saying is there's more safety in a government bond, therefore there's more demand for the product. So the more demand there is for the product, the lower the yield. The more people that are buying 10-year bonds, for example, the lower the yield curve will be, or the lower the yield will be. And that's comparatively to things like stocks, bonds, mutual funds, and real estate, to your point. Is that kind of a fair summary of that as well?
Exactly.
Okay. So it basically implies that there's a lot of fear in the market. People are willing to take a very low return profile because they think that the likelihood that they'll achieve that return profile is much higher than, let's say, even investing in a dividend paying stock, a blue chip stock, for example. The risk return profile starts to be less and less desirable. At least the implications are that people are more interested in investing in bonds, and that's what really lowers that yield curve. Now, the one that most people focus on is the 2-year and the 10-year. Mm-hmm. Before we even move on from that point, why do you think that is? Why is that the one that's most compelling, at least most frequently talked about?
So it'll be the 10 and 2, and then I don't focus on this so much, but I know other people talk about the 10-year 3 months as well. And okay. I think it's because it gives the wide enough range that you can truly, if you're looking at the 2 and 3 or the 2 and 5, they're close enough time periods that it's hard to actually gauge sentiment. I think being able to look at two extremes is why those are some of the most valuable indicators to watch.
Okay, got it. Fair enough, and that's definitely an important data point, especially when you consider that there has been a yield curve inversion, which is taking place recently, which is the inversion between the 2 and the 5. So historically speaking, what is the significance of this? So just to clarify, so the listeners, just to make sure that we're all on the same page, one of the reasons the 10 and the 2 is so important is that it's a big discrepancy. When you get closer to the 2 and 5, the discrepancy is not as big, so the implications are not as significant, but at least it's something. So I'm interested to get your perspective on that, what you personally think that means, and then also historically, if there's anything that's compelling about, the relationship between the 2 and the 5 and the 2 and the 10.
Sure. And we wrote about this at my firm in December because the 5 and 3 went, and then the 5 and 2 went, which we're not seeing both inverted anymore. We're only seeing the 5 and 2 right now. But when that happens, so one, implications are you now see headlines say the most predictive indicator of a recession has inverted. And you go into it and you're like, oh my gosh, like I am a trained economist and I saw that article and I was like, did it? Oh, geez. And so I got really nervous about it. And then I clicked it open. I'm like, oh, come on. It's the 5 and 3. Like that's not the story. But if you're just scrolling through the news and you vaguely know that the yield curve inversion is bad news and you see that, one, that's going to start to induce some fear. But besides that, going more technical, if you actually look at when the 5 and 3 invert, when the 5 and 2 invert, what does that look like over time? What you then see is generally the 10 and 2 follows within 30 to 60 days. And so that's why those articles were really alarming, but you do say, okay, there is some validity to that because historically they have done that. Now, this is the problem with data, is now we're past that 2-month mark and we haven't seen the 10 and 2 invert. And in fact, when that happened, I think the spread was 8 basis points. And again, now we're at 15. So it's not like it's completely widening, but it is starting to pull away from 0, not to any extreme levels though.
Got it. And by the way, I did the exact same thing. So someone actually tagged me in an article that said yield curve inverts basically. And I was like, how did I miss this? I'm kind of embarrassed. But no, it didn't. I mean, I had to comment and be like, no, guys, come on, slow down. Like this is something that's significant. It's not the crazy one though. It's not the one that most people focus on. So, okay. So there is been, in my opinion, one of the most significant experiments in economics, which has taken place in the last, 100 years, which is the entire global quantitative easing that's taken place all over the world. The entire monetary policy has been changed permanently. And this must impact this conversation because this is all about bonds, which is essentially what quantitative easing has to do with. So I wanted to get your perspective on that. And, because of those changes, what does that potentially change about this conversation about the spread between the 2 and the 10?
Yes. This one I have really struggled with personally because you look at QE, like you said, it's a whole different world. You look at these different factors and it's really easy to say, this time is different. And I wanted to know, do we always think this time is different? And so I went on Google and did some targeted searches for the past couple recessions when the yield curve had inverted to see what people were writing. And there were a lot of articles that said, yeah, but in today's economy, XYZ. And then the next cycle you pulled up and it's like, yeah, it did invert, but XYZ. And so I could do the same thing with you today, and I completely agree with you about QE. If you look at where you want to place your money, the U.S. return is higher than in Japan or in the UK or in Germany because of QE in those other countries as well. So I really do think you could reasonably argue that this time is different because of that. And you also need to look at inflation. Because if you're an investor and you're going to tie up your money for a long time and you see inflation, all of a sudden you want your return to be a little bit higher so that at the end of the day, your money is not useless, that inflation hasn't eroded all of your return. And we're obviously not seeing inflation to the level that you'd expect at this point in the cycle. So that could be my other argument of this time is different. I fear being a bit naive or Pollyannish to say that as well.
Totally hear you. There's a lot of things that have changed. There's always something that's changed in the economy that's really significant, and that's what really spurs people to say this time is different. So I hear you on that, but I think that it's a cautionary tale that people should be considering. I think, I've had the opportunity to interview an IMF consultant on the show, and one of the things that he said that it really was very telling is that people think that because the U.S. has stopped purchasing its own bonds, that's really the end of the story. But in reality, we're all so intertwined right now. We really do need to consider the situation with the, quote, global economic markets or the global financial markets. They're extremely aligned. So when the EU goes completely insane to the tune of trillions of dollars, of course that has an impact because people have the ability to buy U.S. bonds that are living in the EU. Mm-hmm. And so it's not like it was, let's say, 100 years ago or even 50 years ago, which is actually, a good point. This came to mind when you were talking, but to your point about people being able to access information. So even in the last 20 years, we've had a very significant change in the ability to access information. So 20 years ago, it may have been the case that economists knew about the 10 and the 2, something like that, or people that watched the stock market, but most people didn't really consider that. But most importantly, the timing at which the 10 and the 2 inverted to the timing at which the mass public knew about it has gone from probably a ton to basically zero. So, do you have any thoughts on like the speed of information? And well, look, if they say that the 2 and the 5 invert, that's a massive implication. It's a massive potential red light that most people would never have even read 20 years ago when the internet wasn't really popular.
Yes. And that's where I think behavioral economics becomes so critical, is self-fulfilling prophecy. So you and I saw that article. Everyone else probably saw an article about it inverting. You start to get nervous. Even after that happened, I had a friend who knows nothing about real estate or about the economy. And they said, hey, I was just thinking about remodeling, but I read something about how the housing market's slowing and the economy is slowing. And I think I'm going to hold off. What do you think about that? And the fact that it's getting down to happy hour talk and to people who don't necessarily follow it to the same extent you and I do, that makes me really nervous of how that plays out to the broader economy, to consumer confidence, to consumer spending. And of course, 2/3 of GDP is consumer spending and how that could impact overall economic growth.
Totally. You look at why most politicians and Fed chairs are just perma bears. Well, you have your answer right there. If they can impact computer sentiment, they can really have a potential of increasing the likelihood that they won't have to live through a recession, because it's really all it is consumer sentiment to a certain extent. Okay. So, again, being a little bit of a nerd, I wanted to discuss the inversion as it relates to interest rates from a historical standpoint. So I went back and looked at a few of the federal funds rates at the time that the yield curve inverted. Now, when I say the yield curve, I mean the 10 and the 2. So it paints kind of an interesting picture. Here are a couple dates, and the dates that they inverted, and then the interest rate, the federal funds rate at the time that inverted. So it's August 1978, 8%. September 1980, 10%. December 1988, 8%. January 2000, 5.4. February 2006, 4.4. And the current funds rate is 2.27. So without even painting the picture, because I think you probably know what I'm implying, what does this mean in terms of if the federal funds rate is so low and the yield curve inverts, what kind of situation is that?
So, Hunter, I love that you are an equal nerd. I think that's quite fun because I did the same exercise.
Okay.
But going back through the 1950s, that's the last time that we have had a recession when the federal funds rate is as low as it is today. And the problem is, you're looking at this data. If you chart out the federal funds rate, you probably remember seeing it kind of bounces. It gets pretty high. Volcker comes in, all of this. But if you look at after the Great Recession, how low and how unprecedented it was, you could not find any point in history that we had any kind of long stretch of close to zero. So I think at first I was really excited for that finding. I'm like, oh, how's there going to be a recession? This hasn't happened since the 1950s. Everything looks fine. And I'm like, what am I talking about? Going back to this time is different. I don't think you can compare to the past recessions as much as I think you and I would love to. But to your actual question, and I know exactly where you're going with that, it's bad news if you hit a recession soon and the current federal funds rate is 2.27%. We need to have tools to stimulate the economy when a recession hits. And one of the tools that the Fed can do is lower interest rates. Can we do that? Sure. Much? No, not to the same extent. You were talking about the January 2000, 5.45%. You at least had more wiggle room back then. Mm-hmm. But it's not just the federal funds rate too. I'm not saying I think it's shifting as I go through my career of where I stand on the political spectrum, but we just did our tax reform bill. You need to use that tax reform bill when the economy is in the slump, is not doing well. And we already played that hand. Infrastructure spending. We haven't done it completely, but we've put some of the budget towards that. We need to have those things accessible to our politicians and to the monetary policy experts so that they can stimulate the economy if and when, we know when a recession will occur.
100%. Actually, you touched on something that's pretty fascinating. I mean, the amount of deficit spending is akin to the heart of a significant recession. And yet we're in a situation in which we have extremely low unemployment. So it's kind of hitting, you're hitting on all cylinders. You got the tax breaks coming, you've got deficit spending happening, and you've got low interest rates. And those are the tools, as far as I know, those are the tools that most governments use to kind of get yourself out of recession. So if you're just smashing the accelerator and the car isn't moving, man, you're going to have some problems. Regarding the federal funds rate, something that Richard Koo talks about is like pushing on a string, for example. I think a better analogy, at least the one that I kind of got from his stuff, is if you have a situation where the interest rates are so low, there's very common, if you have a massive correction in price, it doesn't matter what the interest rates are. The mentality of the buyer pool changes so significantly that debt is not what they're interested in, regardless of how cheap it is. So let's say, for example, that you go to market with a bunch of apples that are rotten. And you're like, oh, they're only $3 an apple. And you're like, okay, we'll make them $1 an apple. And everyone's like, we still don't want them. That's like what it means to be in a really bad situation. Okay. All right. So I use my voice a little bit to kind of get better examples than Richard Koo, who I think has a Nobel Prize or something like that. All right. So let's talk about the quit ratio. This is something that you talked about and really turned me on to in terms of something to follow last time you were on the show. First of all, why is that important? And also, what's the current update in terms of the quit ratio? Because I know it's one of your leading indicators in terms of, where we are in the cycle and the recessions in particular.
Yep. So the quit ratio is one that I started paying attention to as partly a gauge of the labor market and partly a gauge of consumer confidence. I wanted to be able to capture both in one indicator. And so that's why I started looking at the quits ratio. It literally is someone who says, I'm done. Either because, they think they can find a better job and they don't have one lined up, or because they already have one lined up and they're ready to go. So this indicator hit its high, I think it was August, I can't remember exactly. It hit its high last year, but it's still really close to all-time high levels. And I will say, I'm kind of going off script here, is with the labor market, we just put out a report today. I've heard far too many people say, the labor market, non-farm payrolls, the data's coming out great, so everything's fine. And I just think people need to know that non-farm payrolls will not go negative as a leading indicator ahead of a recession.
Good point.
It will not be one of those indicators. So I would be careful. That's
Tell
why.
us why.
So this is interesting because I'm guilty of saying this as well, of saying that a recession is 2 consecutive quarters of negative GDP growth. And for whatever reason, about 3 months ago, I was like, I want to learn every single thing I can about recessions, past recessions, everything. And so I went on the National Bureau of Economic Research's website, and that's the organization that officially calls recession dates. And they basically have in like big letters, A recession is not defined by 2 consecutive quarters of negative GDP growth, even though everyone says it. And they lay out how they define it. And one of their definitions is that they look for peak employment. So they are waiting for employment to keep growing, keep growing, keep growing. So usually, not always, usually the last month that non-farm payrolls is positive, they will call the recession either that month or the following month. So they're not waiting for that number to turn negative. They're actually using that as the official start of the recession. So once I figured that out too, it's like, okay, I put a lot of weight on non-farm payrolls. I am as guilty as everyone else. I literally wrote a rap about non-farm payrolls, but it's not a good leading indicator. But we know that there are leading indicators from the labor market, and that's why I turned to the quits ratio. I was already monitoring it, but it's another reason for me to shift away from the headline number and to look for more abstract ones that could give you a look into the consumer mindset.
Okay, I'm going to circle back on that because I'm definitely interested, and that's not what I thought you were going to say, so I definitely want to make sure I understand it. So could you explain again how they're saying as the numbers are going higher and higher and higher in terms of non-farm payroll employment, at what point do they say, okay, now we're in a recession? I was thinking that what you were going to say was only after the fact can they do that because at the point that they know it peaked, that's the beginning of it. Is that incorrect? Or just kind of walk me through that again in terms of how they calculate that.
No, you are right. And so this makes it even more complicated. And sorry to do this, but they say that they can tell you when a recession officially started at least a year after it happened. So December 2007 was the official start of the recession. It wasn't publicly acknowledged until December 2008. But basically, let me try to find there. So here they say the peak date at the end of 2007 coincided with the peak in employment. So that was the final month of growth in the Great Recession, was the last time that job growth was positive.
Got it. 100%. So basically what you're saying is that it's not a leading indicator because you can only look at it retrospectively.
Yep. Yeah.
Got
I would not pay attention to that. And right before a recession, there are 2 of the past 5 recessions. Right before the recession officially started, 300,000 jobs were added. So you know as well as I do, if you see a jobs report of 300,000 jobs added, you're like, woohoo! Like, things are great, right? Mm-hmm. But that's going to get you in trouble if that's one of the big indicators that you're focusing on.
Great point. Very, very good point. And things start to turn around, particularly when it becomes clear that employment peaked. And that's when you really start to see everyone go, okay, now it's on. It doesn't matter what the non-farm payrolls are. We're not hiring at all. We're not going to redo our house. We're not going to do anything. We're not going to go on that vacation. We're not going to have our conference in Vegas. That's all that stuff starts to happen once it's official. So that's a good point.
And then the layoffs start happening as a result of all of that. You don't cut the jobs first. You start to say, things look a little shaky, but let's just pull back on this conference. But if you're not doing that conference, do you still need a marketing team of 10?
Yep.
Probably not. So then things start to trickle out from there.
Great point. That's really important stuff. Okay, so what other leading indicators are you looking at right now in terms of recessions? And is there anything else that we should be focusing on?
So to keep with the quits, I will say it generally still looks positive for that indicator. I think we talked about millennials last time I was on here. We do a millennial survey every year. 25% of them quit in the past year and got at least a 5% bump. So the good news is when people quit, you are seeing an accompanying raise after a really long period of not hitting wage growth. I don't think that's going to make up for the huge divergence between wage growth and home prices. But that's just another, I look at quits and employees who are not concerned about losing their job, which that to me is another gauge of if you think you're going to have a paycheck 12 months from now, 18 months from now, you're probably going to buy the shoes or the TV or the house or the car. So look at those. But if we want to look at tried and true recession forecasters, knowing every single recession is different, so who knows if they still apply to today. Obviously, the whole reason we talked today was about the yield curve. If and when the 10 and 2 inverts, that's usually 6 months on the short end, 24 months on the high end, usually between 12 and 18 months before next recession. We haven't seen that invert yet. Another one, which is a very long leading indicator, is when the economy gets to full employment. So in this case, I'm very happy using non-farm payroll data, but I want to look at the unemployment rate. And so I define full employment as 4.5%. Just as a reminder to people, the full employment is generally people that want jobs, have jobs. And so you'll hear some economists say full employment's 3.5%. Some will say 5%. But for me, I'm comfortable with 4.5%. And you look at when that triggered. Historically, a recession has started 3 years after that date. So if you look at that indicator, what that's saying is about mid-2020 based on that one indicator. And I will say you probably have people who do not trust an indicator that gives 3-year warning.
Yeah.
And I actually was talking with one of my friends who worked for Bloomberg, and obviously it's her thing to challenge data. And she's like, that's crazy. Like, there's nothing that can predict a downturn in 3 years' time. And we got in this huge debate about it. And I was like, one, it's happened almost every single cycle when you get down to 4.5%. But two, think through the logic. When an economy gets to full employment, there starts to be fears of a market overheating. You start, and not so much today, but you should start to see wages go up.
Yep.
Wages going up, causing pressures on the businesses. So it almost just, as the economy gets so strong, it starts to put pressure on businesses. So to me, I can see the logic of why that is a good leading indicator 3 years out.
Yeah, certainly. I mean, it's just an important part of the entire business cycle.
Mm-hmm.
That is a critical element of that whole wedge growth, pressure on businesses, quasi-inflation, something like that. So Thanks for sharing that. It's definitely important. Okay, any other indicators, or can we move on to real estate?
We can move on to real estate.
Okay. So given what we've talked about today, given the combination of the economic data points and the not so much serious wage growth, you mentioned the huge discrepancy between the super increasing in prices of real estate as opposed to the lack of increase in income. What does a recession mean for real estate prices right now?
Mm-hmm. So that's another thing that I spent a lot of time researching, is what happens to prices historically in recessions. And so I pulled up the past, past six recessions. Of the 6, 2 had really substantial double-digit nationwide drop in pricing. Obviously, Great Recession being one of those. 2 had pretty moderate pullback in pricing, down 5% for 2 of them. 2 had prices increase during a recession double digits, which really surprised me when I saw that data. I was not expecting that prices would continue to go up. And I don't think in today's marketplace, we expect to see prices go up during a downturn. I think there's been a big shift in supply and demand that throws that off. Mm-hmm. We don't have as much supply, and we have a lot of people that are competing for homes, and they're bidding up prices. And I would say in some cases, artificially bidding up prices. So I don't think there's a uniform answer that you should expect prices to go down. But if I were to forecast what the next recession looks like, I would put it at that single digit decrease, as long as we're able to. And the reason I do that is because of demographics. So as long as we're able to keep some millennials employed that potentially are going to become home buyers and they earn a decent enough income, I think the demographics will be able to drive the housing market forward, even if the market slows a bit.
That's actually really good information. Frequently we have guests that come on the show that, well, obviously I appreciate you making some sort of a quasi prediction, because I know that that's kind of challenging to do sometimes.
Delete it.
No, I appreciate it. I do appreciate it. But also, I mean, that's actually really good information. I think that's really important for people to understand. 2005, 2008, that was the aberration. That was not the norm in terms of recessions. It is not typical to have, I mean, it's completely ahistoric to have a 33% decrease in national real estate prices. That is like a once 100-year type of situation. Most of your investments out there should be able to withstand a 5 or even a 10% correction in price without you having challenges with your loan, which is typically how things really go wrong. However, that is over the aggregate. If I could invest in the aggregate, I'm pretty confident that that's really what the result would be, because the sample size is so large that it's probably going to end up being in those historical norms. However, that's not at all what happens. What usually happens is that people have a lot of their investment or their entire real estate investment or their entire business focused on one market or even one zip code. So I wanted to get your perspective. There's a couple markets that come up all the time on the show in terms of being extremely hot, not necessarily inflated, but hot. There's a lot of volume. There's a lot of interest. All the investors are concerned about it.
Yep.
So let me ask you 3 questions. And if there's no answer or you don't have the data for it, no problem. But I just wanted to ask because it's coming up a lot. The first one is Denver, which we did talk a little bit about last time. I've been there recently. It is unquestionably popping off. There is a ton of $100,000 plus jobs there, and they're not coming there to build houses, to your point on our last interview. So what are your thoughts on the Denver market, and what does a recession mean for Denver in particular?
So for Denver, let me try to explain this. I want to talk about the price data before I go into recent trends.
Okay.
But for Denver, we like to look at markets. What was their price during the previous peak? And what is their price today, adjusting that for inflation? Now, you could pull up any graph of Denver's housing market. It did not look like Las Vegas or Phoenix or Orlando. It was not a crazy boom bust market. It was a fairly steady market. But prices today compared to previous peak, adjusted for inflation, up 31%.
Okay.
Now, I mean, that's insane. It's really, really crazy how expensive Denver has become. I don't know if I said this last time, but I went and toured. I've been to Denver a lot. I go there for work often. And when I go, I tour different communities. And for Denver, I'm born and raised in Cleveland, Ohio. And if I go to Denver with my Midwest lens or my Southeast lens, Denver is expensive. Your bang for buck is not really there. Now, if I go with I live in California now, my Southern California lens, Seattle, Bay Area, it still has some relative value. So I think you have to look at where a lot of the in-migration is coming from, because if there are a lot of people from Charlotte, Raleigh, Orlando, Columbus, Minneapolis that are going to Denver, it's going to be pretty tricky for them to find a reasonably priced home in an area that they want to live. One thing that I think, at least this is more on the new home building side, but I think it's interesting as it relates to existing homes. We've noticed in Denver, everyone says California is the hub. This is where all the new architectural designs coming from. This is where, if you want to look at what housing will look like in 5 years in a different market, look at California. I truly think because Denver has never experienced home price appreciation like it has during this cycle, I think that the builders in Denver have become very smart, and they've done really interesting products, and they've been able to lower the square footage, yes, increasing price per square foot, but I think in some ways they've been able to capture some of the lower price points that a lot of other markets are struggling to do.
That is really interesting. And I definitely was not privy to that in any way. So that's really interesting. So, I mean, what do you think, if there is a turnaround in terms of the global or the national economy? I mean, do you think that Denver has a significant pullback then?
See, I'm happy to forecast on the national level. Then you're telling me to do it on the local.
I'm pushing the limits.
You are. So for Denver, I think there will need to be a bit of a price correction in that market. Yes, I think if you lose your dual income households, if someone has to lose a job during the cycle, I think it will be fairly difficult for some to be able to service their mortgage.
Yeah.
So I think they'll see some adjustment to prices downward.
Yeah, that's a fair point. Okay, well, first of all, I did not expect that level of detail, but that's I really appreciate it. And not to set expectations for the other 2 cities I want to ask you about, but just that was awesome. So the other one that comes up a lot is Austin. Mm-hmm. Obviously, very similar situation, maybe ahead of Denver in terms of where they are in terms of how long they've been able to do that growth, because they're basically 10 years into that kind of amazing growth now. So what are your thoughts on Austin, and what are you thinking the downside there is in terms of a correction?
Austin, to me, I was there a few months ago. How should I describe it? I found Austin to be working very hard to maintain its reputation as the next big tech city or the next big millennial city. And I think those efforts have been very good for the local housing market. This one, I found the homes slightly more affordable than I expected going in. That doesn't necessarily mean it's a steal. I guess I just thought because there's so much immigration to this market that it probably was seeing really rapid appreciation. And I still think it was. But this one to me feels a little less frothy than I'd put for Denver.
Fair enough. It's good to hear. I definitely have a lot of investments in the Texas markets in general and Austin in particular. So that's awesome. And again, I want to say that I do appreciate you sharing that with us, especially using the word feel in there, which I know it's hard to compartmentalize the data and your actual expectations. When you go on site to the markets, you actually do get something that's not really coming through in the graphs and the charts and the immigration statistics, for example. So I appreciate that. Let's move on to Phoenix. Phoenix is a very unique one because there is a lot of land and you can get incredible houses there in all stages of the cycle because of the fact of that. So what are your thoughts on the Phoenix market and, the potential downside there?
So back to the stats that I talked before about previous peak to where we are today, adjusted for inflation. Phoenix is one of those markets, whether or not we want to admit it, was one of the bubble markets. It just rapid appreciation, huge crash. Took a while, actually a lot longer than I think a lot of people expected to pick up steam during this cycle. Maybe only the past 3 years has really seen some of that strength. When you look at prices, still actually down 20% compared to the previous peak. So that stat really surprised me. Again, it is adjusted for inflation. If you're not adjusting for inflation, it's above previous peak.
Right.
But for Phoenix, we have a local expert on the ground who is saying even though prices do look below previous peak, if you're in Phoenix, people are talking about how it feels expensive.
Right.
And I think that's really interesting because you almost wouldn't expect that. But if you want to be somewhere more central for Phoenix, because I know you can go to the far out suburbs and you can find the land and all of that's great, but you can find a big home at a relatively good price. If you think closer to Scottsdale, you're still facing affordability struggles, even though the numbers don't show it the same way as you would expect.
Okay.
Phoenix, to me, I don't think has as much downside risk as well. I think it's still working its way up.
Interesting. Okay.
But it has slowed in recent months.
Well, there's been a lot of markets that have slowed, and that's definitely the case in probably all of those to a certain degree, even if it's just the speed of growth has slowed, which is kind of a weird metric, but it's used all the time.
Yep.
So we've talked about the downside there a little bit. Before I let you go, I definitely want to hear about any markets or asset types, anything like that you think is presenting a real clear opportunity from an affordability standpoint or otherwise. Is there any metropolitan areas where you're seeing a lot of activity that you're thinking, man, there's a lot of downside protection, there's a lot of growth potential as well?
So this one's interesting because I hear a lot of people talk about Orlando or Tampa or Columbus, all of the markets that if you look at an affordability ratio, you would look at Charlotte. And let's say I don't know this exact number, but let's say it says 45% of households can afford the median price new home. Now that's 45% in Charlotte, where if you look at the same data in LA, it's 11%.
Right.
So if you look at just that stat alone, I think people would say, well, that's great. There's huge opportunity in Charlotte. That's where we should be going. It's still really affordable. I think that's when you need to look at market comparisons across the nation don't really make sense. You have to look at the market relative to itself. And at least in my experience going to Charlotte and going to all of these, maybe not second tier markets, but the less expensive markets, there doesn't seem to be the low hanging fruit opportunities as you would expect just looking at an affordability ratio. I think it's become very, and this is what stinks about housing, is how local it is. I think it's really become submarket, product in that submarket, schools in that submarket. And it doesn't necessarily have to be the best schools. We even ran some analysis, and I think everyone says, well, if you buy an 8, 9, or 10, it's a slam dunk. Everyone wants to have good schools. I completely agree with that. But we ran the analysis for one of our markets, and the best selling great schools score was a 5. And so that's not the best schools. That's an affordability play. And I think a lot of Americans are at the point that you got to compromise on something. And I don't think everyone will compromise on schools, but in some case you will do schools. Sometimes you'll do square footage, and sometimes you'll do location. But I think it's become a lot harder to just easily find opportunities today, because even markets like Baltimore, Chicago, Toledo, you could say relative to themselves, they're at a really good place from an affordability standpoint, but I'm not sure I would call those great opportunities unless you really feel good that Chicago is going to overcome some of its political challenges and Baltimore is going to overcome some of its stigma challenges. Unless you really know those markets well, I would be careful dabbling in the ones that look like an obvious steal, because there's no reason there should be any obvious steals this far into the economic cycle.
Absolutely. Great point. I mean, you touched on a lot of things there. I invest in a variety of asset classes, and you can get incredible mobile home park deals in Jackson, Mississippi. The problem is that you can also get incredible houses there. So, if you can buy a house for 20 grand, there's probably a reason for that. And certainly no one's going to be renting a mobile home if they can buy a house for 20 grand. It's basically the same price as mobile home. So, Allie, I really do appreciate you going to that level of detail. I know I'm always going to try to push the limits in terms of what you're comfortable saying. So I really do appreciate you taking the time to come on the show and to discuss a lot of stuff. But before I let you go, I do want to give the opportunity to let listeners how they can learn more about you, what your firm does, and just any other publications you have.
Sure. So as mentioned, we're Meyers Research. We just recently merged with our biggest competitor. So now we are Meyers Research, we are Hanley Wood, we are Metro Study. We are the number one data provider for the new home housing market across the country. Our website right now is still going to just be MyersResearchLLC.com. My email is awolf, like the animal, at MyersLLC.com. And I'm very active on LinkedIn. I share a lot of our research. So if you'd like to get access to our blogs, we have a free blog platform. We also do feasibility studies and market analysis for different expansion markets across the country. So we're doing a lot, but mostly focused on the new home space. We have apartment experts. We have commercial experts as well.
Awesome. Well, we will link to all of that in the show notes page. Allie, I really appreciate you coming on. Thanks again.
Of course. Thank you.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.